Hometown Heroes uses $11 million in one day. Rates shoot up even with good inflation data. And what is going to change to say, some people have called this a broken real estate market because they just can't figure out how to get more inventory or what's going to cause more inventory in the market. So we're going to look at some ideas on that and what's likely to change over the next year or two. Hey everyone, it's Rayce Robinson, your favorite Florida mortgage broker, and I want to start with Hometown Heroes because it's probably the biggest thing that impacts our market here. It's definitely pushing a lot of buyers into the market, and we are pre-approving a ton of Hometown Heroes buyers. That doesn't mean they're getting their offers accepted, but it means it is pushing people into the market even with higher rates. You can see right here with Hometown Heroes, they used $11 million the first day, $20 million the first week, and there's $100 million allocated to this program. Why is that important? Is because I really thought this program would run out of money in about 60 days. Maybe it'll go 90. It does slow down, obviously, when we get past the buying season. The real question and that you want to know as a real estate agent is, think of this as musical chairs. When we get a Hometown Heroes contract, we can only lock it in for 30 days and we can't do rate extensions. And so when we get a new contract, we have to make sure we lock in at least to the contract date and usually a few days extra to have a little bit of leeway. What if the seller needs to delay at the end and now the buyer can't do Hometown Heroes because we didn't lock it in far enough? But if we don't lock it in up front and Hometown Heroes runs out of money, then it's not allocated until we lock in that rate. So think of this as musical chairs. There's going to be a day in the next 30, 60, 90, 120 days that the Hometown Heroes is going to run out of money. And on that day, there's going to be contracts that are being written for Hometown Heroes. There's going to be people that are getting ready to write contracts. And there's actually going to be people that are underway in the loan process that have just started that haven't locked in yet because the lender didn't lock it in, rightfully so, because they couldn't cover the closing date or they wanted to get a couple days extra. So there's going to be a lot of upset people the day that happens because there will be a lot of upset buyers and realtors and mortgage people because when the money's gone, the money's gone. So it's just good to know that the money's going very quickly and that, if you have someone out there looking, obviously the sooner the better, and as soon as possible you want to get those locked in at least past the closing date. Now let's look at interest rates. 30-year fixed rate mortgage rates really shot up and then kind of came back down. But if you look here, it's just, again, more of the same, really locked into this high six, mid sixes to seven range. And even with CPI coming in lower, inflation data coming in lower, the Fed is really stuck on fighting inflation for longer. And that means that's going to keep rates higher longer. Now, that's what they're saying. And it pretty much all that on the 26th when they meet again, they're going to raise the Fed funds rate again. I didn't think they'd do that. I really thought after July they would continue to pause because even when they raise rates, it takes a while for that to impact the market. So I really think they're kind of over tightening in my opinion, but I don't get to vote. But I will say that the bond market, which is the smart money, is still predicting them to lower the Fed funds rate as the year goes on. One thing to here, I'd like to look at the pending sales. Regardless of what data is showing, there's still a lot of activity. I thought this was interesting as far as, look right here, and this is Redfin data, June of 2023. Just look at more as the visual. These are pending sales. You can see even with COVID, when things were going crazy with rates, we still have a lot of transactions. We're kind of getting close. This is like May. We could go back to May of 2019, and we're in the range of almost where we were at in 2019 and where were rates at in 2019, call it 3 to 4%. Again, why is one of those things that's important is I like to show buyers that regardless of where rates are at, people are always buying and selling because they need to. But if rates fall, which they definitely will with inventory staying flat at some point, then that's going to push more people back in the market. It's going to create more competition, less and less, inventory because it's going to get sucked up. And investors really have not slowed down when they look at the investor share in Florida. A lot of investors and these big hedge funds still buying a lot of real estate in Florida. Now, Fannie Mae is saying nationally that they're predicting housing prices to be down in 2024 by 3.4%. But again, that's national. A lot of markets are going down faster than others. Really, Central Florida has really not went down at all. And if you look at the chart from Fannie Mae, they're predicting rates at the end of 2023 to be 6.4%, in 2024 to be 5.9%. And there are a lot of people predicting rates to be lower than that. I really think rates will be under 6%, closer to 5.5% by the end of the year. Let's call it first quarter of 2024. And that's where you do need a mortgage person that spends time, forget about interest rates and trying to save someone $20 a month on the payment. The most important thing that I can do right now when I'm talking to a buyer is spend some time with them, alleviating their concerns and fears, showing them a refi plan of where rates could be and what's the strategy. Should they be paying points and buying the rate down, and having that conversation up front, because the more confident your client is on the lender and the mortgage person, and that is directly related to how much time we spend during their pre-approval, the more confident they are out there when they're buying. And again, I think all of this data with Fannie Mae, they're showing a pretty flat market, lowering rates, which is why it's really hard to get a return on investment on Zillow and some of these things, because you need a wider net than you've ever needed before, especially if you're working with buyers, because we have to pre-approve twice as many buyers to actually get under contract than we used to. And if the cost of that net is too expensive, the return on investment doesn't make sense. So you do have to have a wider net. That can be things like video and social media, phone calls, whatever it is that you specialize in getting good at. But spending money and buying leads just right now still is hardly working. I'm sure there's always exceptions, but it's so expensive to pay for that net that it's hard to make those numbers work. One thing you can do is join us on classes on Tuesday. We just had a rookie to Rockstar, the secret to 12 transactions in 5 months. And being around what other people are doing that are working for them is a great way to learn. Getting mentored. If we haven't spent time together, I've been a mortgage coach for years as well. And a lot of the strategies that we use to build our mortgage presence is the same thing you would do as a real estate agent. So that's what the data shows now. If you have any questions on this or anything else, reach out to me. I'd love to help. As more information becomes available that moves the market, as always, I'll cover it here. Have a great week. It's Rayce Robinson, your favorite mortgage broker, favorite Florida mortgage broker. Let me know what I can do to help. Thanks.